From Nebraska, Mr. Fortenberry.
Thank you, Mr. Chairman, for holding this hearing, and thank you, Chairman Lucan, for appearing today. Let's go back again to the essential question. On Monday, a hedge fund manager and oil company advisor testified on Capitol Hill that it was his perspective that increased regulation would drop the price of a barrel of oil to $65 to $70 in about 30 days. With that said, this is not meant to be a challenge to you, but I want to unpack precisely what you're saying, because it seems to me you're saying two things. One is you do believe that the futures market are an accurate indicator of underlying fundamentals. And yet at the same time, you've pointed to the fact that there's been an enormous increase in speculative activity, that speculators actually hold a higher percent of overall market activity. It was very important to act on closing the Enron loophole. You're concerned about transparency, particularly in the swap markets. So that indicates that, again, there is a reasonableness of concern that speculative activity, or the acceleration of speculative activity at the moment, leaves the question as to whether it is a driver of price, creating an artificial price beyond the underlying fundamentals. I'd like you to respond to that.
Well, we do not have any direct evidence that speculators or index money seems to be moving these markets. And the way we look at this, and with the data is very good with the agricultural markets, we look at a variety of different agricultural products that have large institutional money coming into them. And so this is corn, soybeans, hogs, cattle, all of them. The largest of percentage-wise of the markets that have institutional money is with cattle and hogs, around over 40%. And so you would think, theoretically, that they would have the highest prices of all as a result of this institutional money. It's actually, until recently, it's actually been negative. It's in positive territory now, but certainly it's one of the weaker commodities that we've seen with all this institutional money. So again, we're trying to ensure that if it's correlated, you'd think we'd see that. We see other markets with no institutional money, such as the Minneapolis Grain Exchange and wheat. So no index trading going into those markets. Again, huge price run-ups in those markets without any of this buy-side pressure that's being talked about. And so why is that occurring? Of late, the last 3 months, we've actually seen a decrease in index money in the agricultural markets. It's flat or slightly decreasing over the last 3 months during price rises for commodities. So again, we're looking for a smoking gun. We're trying to find it. That doesn't mean we shouldn't continue to look to try to get better data, to try to see if there's some correlations here. But to date, we haven't found the evidence.
I had looked into this question a number of weeks back when we began to experience the significant spikes, and the economists, the analysts back then were saying $10 to $40 is the effect of speculation in these markets. And again, let's go back to this testimony of this hedge fund manager who said increased regulation would drop it back to 65 to 70 in 30 days. Now, there's concern there that this might push activity overseas, and we've talked a lot about that. But let's tick through the types of regulation this person would be referring to and look at the possible effects.
Well, I think he's talking about banning institutional investment, so prohibiting pension funds and others from investing any of their money into the markets. I think that's a bad idea. I don't think we should limit the free flow of capital in a market system. I think there are ways that we could try to manage that money and develop practices. That's something that we're thinking about. That's why we're trying to get better data in this area. But to take drastic steps with the hope that this would drop prices in half, it's intoxicating. I agree. I mean, boy, if I were a consumer, I would love to hear that the steps that we take are going to drop prices in half. But I think we need to be measured. I think we need to be careful because once these markets go, they may never come back.
Thank you, Mr. Chairman.
Thank you, gentlemen. Gentleman from Ohio.